Hello, everyone, and welcome.
I'm Amy.
And I'm Tom.
We're here to help you get up to speed quickly on some really important market and global events. We're pulling key insights directly from the sources you've shared with us today.
Yeah, our mission in this conversation is to, well, untangle this pretty intricate web of recent central bank decisions, market reactions, and of course, the escalating geopolitical tensions that are really shaping the global economic landscape right now as of June 20, 2025.
And hopefully by the end, you'll walk away with a much clearer picture of what's happening and, crucially, why it matters.
Okay, so let's jump right in. It sounds like central banks around the globe are navigating very different economic currents. That seems to be leading to some truly divergent policy decisions just this week.
Absolutely. It's fascinating, really. You see how each bank is trying to respond to its own domestic situation, but they're also, keeping a very close eye on these global pressures. It's a balancing act.
Right. So where should we start? Maybe the Bank of England? What did they decide?
Good place to start. So on Thursday, the BOE decided to keep its benchmark interest rate unchanged, still at 4.25%,
Okay, holding steady?
holding steady. But the interesting part was the vote by the Monetary Policy Committee, the MPC. It was 6-3 in favor of holding. But that minority, which included Deputy Governor Ramsden, they actually wanted a cut, a 25 basis point cut, right now.
Wow, a 6-3 split.
Ah.
That really shows some internal debate, doesn't it? Pushing for a cut even while the majority holds.
It does. And they didn't offer any changes to their forward guidance either. Still talking about a gradual and careful withdrawal of policy restrictions. They repeated that policy is not on a preset path, though Governor Bailey did say rates are on a gradual downward path. So a little hint there.
A hint, but cautious. So what was their main reason for holding firm despite that split and, well, market hopes for maybe a clearer signal?
Well, the MPC pointed to underlying weakness in economic growth. And they noted the labor market seems to be loosening up a bit. They used the phrase clearer signs of a margin of slack opening up.
Okay, slack, meaning the economy isn't running quite as hot.
Exactly. More spare capacity. And that, they said, is leading to disinflationary pressures building. Basically, signs that inflation is cooling.
Right.
But they also flagged two-sided risks to inflation, meaning they're watching for persistence, inflation staying stubbornly high, but also vigilant about things like the Middle East situation and energy prices potentially pushing it back up.
So kind of looking in both directions at once, how did the market take that?
The interest rate market definitely reacted. Bets on an August rate cut increased significantly. They call it a steepening, now pricing in about an 80% chance of a cut in August
Yeah.
and expecting another one later in Q4.
80%. That's pretty confident. So the market's essentially saying, we hear your caution, OBE, but we think a cut is coming soon anyway.
That's a fair reading and highlights this tension between the official cautious stance and market expectations, which seem focused on that underlying weakness.
Interesting. Okay, so that's the UK. How did that compare with, say, the Swiss National Bank? I heard they also made a move.
Yeah, a very different picture, which really underscores this divergence theme. The S&B, earlier on Thursday, they did cut rates. It was expected, but maybe a bit smaller than some in the market were hoping for.
And why the cut there? What's driving Swiss policy?
Primarily, the strength of the Swiss franc this year has been really strong, and that helps keep import prices down, pushing inflation lower. In fact, Swiss consumer prices actually fell 0.1% year over year in May. Deflationary pressure.
Fell? Wow.
Yeah. And the S&B forecasts inflation will average just 0.2% this year. Tiny. So a rate cut makes a lot of sense for them.
Okay, so Switzerland cutting makes sense with falling prices.
Hmm.
But then I heard Norway, Norges Bank, actually delivered a surprise rate cut. That seems counterintuitive.
It was definitely a surprise for many. You're right, price growth has been a bit stickier in Norway over the last year, partly because the Norwegian krone, their currency, hasn't performed as strongly. But a key measure of core inflation last month hit 2.8%, matching the lowest level this year. And Norges Bank is now forecasting headline inflation next year will be 2.2%, much closer to target, even though this year is still seen around 3%. So they seem to be looking ahead, anticipating that cooling trend will continue.
Got it. Looking past the current stickiness. And what about the ECB, the European Central Bank? Any shifts in expectations there?
Well, money markets are still pricing in the ECB's deposit rate heading 1.75% by December. That's down from the current 2.00%. But the chance of the next 25 basis point cut happening as soon as September, markets are currently seeing that as less than 50-50. So still some uncertainty there.
Okay, so summing up the central banks, We've got the BA holding but hinting downwards, the SNB cutting cautiously, Norway surprising with a cut, and the ECB maybe cutting later. It really paints a picture of complexity, doesn't it? Policymakers juggling very different domestic realities.
It absolutely does. A real mixed bag of approaches. And these decisions, alongside everything else happening, are clearly filtering through to the markets.
Right. Let's talk about those market reactions. How did currencies respond to this central bank divergence and the general uncertainty?
Well, the US dollar actually dipped slightly on Thursday, partly because these European central bank decisions, well, they kind of highlighted the challenges policymakers are facing everywhere. Heightened economic uncertainty tends to weigh a bit on the dollar sometimes.
Okay. And the euro and the pound specifically. How did they fare after their respective central bank news?
The euro saw a small gain, just about 0.11%, hitting 1.1494 cents. But the pound sterling, that showed more strength. It rose almost 0.3% against the dollar, reaching 1.3461 after that BE decision.
Ah, interesting. So the market liked the BE's message,
Yeah.
even if it was cautious.
It seems investors felt it provided maybe clearer guidance or at least reduced some immediate uncertainty about the path. And it's worth remembering the pound has had a strong run against the dollar this year, generally up almost 8% year to date. That's quite significant. The pound also firmed a little against the euro, trading around 85.4 numbers. On the other hand, the dollar did gain against the Japanese yen, up about 0.25% to 145.43.
Okay.
And one key thing to remember for Thursday's trading euro, U.S. markets were closed for the Juneteenth holiday.
Right, that's important context.
Yeah, lower trading volumes often mean less liquidity, which can sometimes exaggerate price moves, so that probably played a role too.
Good point. So currencies reacting, lower liquidity.
Mhm.
What about commodities? Usually uncertainty sends investors towards safe havens like gold, and geopolitical tensions hit oil hard. What happened there?
You nailed the dynamic. Gold prices were pretty much flat on Thursday, kind of caught in a tug of war.
How so?
Well, on one hand, those rising geopolitical tensions we mentioned definitely provided support. Gold is that classic safe haven asset people turn to when things feel unstable.
Makes sense.
But pushing the other way was the Fed's still relatively hawkish stance, leaning towards keeping rates higher for longer to fight inflation back in the U.S. Higher rates make non-yielding assets like gold less attractive compared to bonds, for instance.
So geopolitics pulling it up, Fed policy pulling it down, a stalemate for the day.
Pretty much, although year to date, gold has done very well, up over 28%. That shows the underlying demand for safety this year.
Wow, 28% is huge. Okay, but now, oil. That wasn't flat at all. You said prices surged. Over 1.5%? Brent hit its highest since January.
Exactly. Brent crude jumped $2.49, that's over 3.2%, to close at $78.74 barrel, highest since late January. And WTI, the U.S. benchmark, was up over 1.5% too, settling at $76.
So what specifically caused that big jump? It sounds like more than just general uncertainty.
It absolutely is. It's being directly fueled by the intensifying conflict between Israel and Iran, specifically the aerial attacks. Plus, there's huge uncertainty about potential U.S. involvement. That combination has markets really on edge.
Can you give us a bit more detail on the conflict itself?
Sure. Reports indicate Israel conducted airstrikes targeting nuclear facilities within Iran. Iran then retaliated with missile and drone attacks on Israel, reportedly following an overnight strike on an Israeli hospital. Critically, neither side seems to be signaling any clear way out of this escalating cycle right now. That lack of an off-ramp is deeply concerning for stability.
And the rhetoric. What are leaders saying? That often signals where things might be heading.
The statements have been very strong. Israeli Prime Minister Netanyahu said Tehran's leaders would pay the full price. Iran issued a stark warning against any third party getting involved, a clear message aimed outwards.
Towards the U.S., presumably.
That's the widespread interpretation. And adding to that, the White House stated President Trump is expected to decide on potential U.S. involvement within the next 2 weeks.
2 weeks. That hangs a huge question mark over the markets.
A massive one. And the economic implications here are very direct, especially for oil.
Because Iran is a major oil producer, right?
Exactly. Iran is OPEC's third largest producer. They pump around 3.3 million barrels of crude oil every single day. Any disruption there would ripple globally.
And it's not just their production, is it? There's the shipping route, too.
You're pointing to the Strait of Hormuz. Absolutely critical. It's a narrow waterway off Iran's coast. Estimates vary slightly, but something like 18 to 21 million barrels of oil and oil products pass through there every day.
18 to 21 million.
Daily.
Daily. That's about a fifth of the entire world's daily oil consumption squeezed through that one narrow channel.
Wow. So any disruption there would be catastrophic for oil markets.
It would be incredibly significant. Prices would almost certainly spike dramatically. So that threat hangs over the market constantly during this conflict.
Amidst all this tension, what are other major players like OPEC Plus saying? Are they reacting? Interestingly, Russia's top oil official, Deputy PM Novak, actually argued this week that OPEC Plus should stick to its existing plans to gradually increase oil output. He cited rising summer demand as the reason, but he also advised caution, saying they should be measured and avoid spooking the market with speculation. So, trying to project stability amidst the chaos.
A delicate balancing act indeed. Okay, so we've got central banks diverging, currency shifting, gold holding steady, but oil surging on very real geopolitical fears. What about the bond markets? Fixed income is usually seen as calmer. How are they digesting all this?
Well, calmer is relative right now. Eurozone government bond yields did tick up modestly on Thursday. It reflects that ongoing investor caution.
So yields up means prices down slightly. Investors demanding a bit more return for the perceived risk.
That's the dynamic. For example, UK 10-year government bonds, gilts, saw yields rise 3.4 basis points to 4.532%. German 10-year bonds, the benchmark for Europe, were up 2.3 basis points to 2.523%. Longer-term German bonds also saw yields rise. Interestingly, the very short-term 2-year German yield, the Schatz, was actually down just a tiny bit.
Okay, so mostly yields drifting higher. What about countries sometimes seen as riskier within the Eurozone, like Italy? How did their bonds react?
Good question. That's often where you see stress show up more clearly. Italy's 10-year bond yield climbed more significantly, up 6.8 basis points to 3.520%. And that meant the difference between Italian and German 10-year yields widened.
A risk premium, essentially.
Exactly. It widened by 4.5 basis points to nearly 100 basis points, its highest level since late May.
Yeah.
That widening spread signals rising investor nervousness about the periphery amidst the global uncertainty.
And any other geopolitical events influencing bonds, besides the Middle East?
Well, looking ahead, markets are also keeping an eye on next week's NATO Leaders Summit. There were reports in the Financial Times suggesting it's been scaled back to just a single session.
Oh, why?
The report suggested it was possibly an effort to prevent an early departure by President Trump, like what apparently happened at the G7 meeting earlier this week.
More political uncertainty adding to the mix.
It just adds another layer to the complex geopolitical backdrop that markets are trying to navigate.
Okay, so quite a turbulent picture overall.
Mm-hmm.
As we look towards wrapping up, what should people be watching today, Friday, June 20th? Any key data points?
Yes, definitely a few things on the calendar. We've got the German Producer Price Index, which gives clues about inflation pressures earlier in the supply chain. There's also a Eurogroup meeting, the ECB's Economic Bulletin for more commentary, and Eurozone consumer confidence figures.
And in the U.S.?
Key releases include retail sales data, really important for gauging consumer health, the Philadelphia Fed Manufacturing Survey, another regional economic indicator, and the Federal Reserve's official monetary policy report submitted to Congress.
Lots to digest still.
Yeah.
It really brings us back to that central question, doesn't it?
It does. You know, in a world where central banks are clearly going in different directions policy-wise, and these geopolitical flashpoints, like Israel-Iran, are having such direct, immediate impacts on vital resources like oil, how do all these short-term market reactions eventually feed into the longer-term economic story? What does it all really mean for global stability going forward?
And maybe more personally for you listening, as central banks try to manage these disinflationary trends alongside these geopolitical fires, what could be the next unexpected ripple effect? How might it touch your everyday life or maybe your long-term investments? Something to think about. Thank you for your attention. You can subscribe our podcast if you like it. See you next time.